Welcome back to episode 9 of the ICT Mastery Mentorship. In this episode, we're going over impulse price swings, okay? Now, impulse price swings, we have impulse price swings and then market protraction. Those are two different things, okay? Impulse price swings, right? For example, if your narrative is bearish, right? In which we already see price is bearish here. If your narrative is bearish, right? Whichever impulse price swing or price swing that is bearish, that's a impulse price swing. Any other price swing that is moving higher or against your narrative, that is market protraction. We'll go over market protraction in a different video, really explaining what it is and the manipulative factors of it and everything else. But here we're just going over, I might make this a little short, I don't want to make it too long. We're going over impulse price swing, okay? So from this little range here, I guess you could say, your entire narrative is bullish, okay? So, impulse price swings, okay, are forms of displacement, okay? Remember, I taught you about displacement before. What occurs or what forms within displacement? It's fair value gaps. Fair value gaps form within displacement. In the last episode, I taught you what fair value gaps were. So, if you can just point out any fair value gap, it doesn't even matter. It can literally be anything. This, that, literally. But if you can see where a fair value gap is, what it is, and the purpose behind it, then yeah, you know what a fair value gap is. But that's what an impulse price swing is. It's a price swing that follows your narrative, okay, or your bias on price, or your prediction on price, and it heads in your direction. That's an impulse price swing, right? So if you have a swing down like this, if your narrative is bearish and you have a swing like this is a impulse price swing. Anything opposite to that would be market protraction. I'll be going over that in a later video. But here, I can grab a little thing. Oh my god, on my drawings. You know what? We're gonna go back. But here, right here is an impulse price swing, right along there. Bang, impulse. We have another one. Bang, impulse. We have another one. Bang, impulse. But market protracts into what? Liquidity. See how these are the highs right here? Yep. Came and smash those highs. Market protracts, and then it impulses. Bang, following your narrative. Okay. Very simple. And it even does it here. Market protracts. Bang. Into what? That high. Finally impulses down. Very, very simple. It's nothing hard, nothing hard. It's very easy, honestly. But if you want to go through it here, sure, why not? Looking at it again. Price protracts. Comes into these highs. Impulse. Market protracts. Impulse. Market protracts higher. And then finally, impulse. Bang. Market protracts. Impulse, bang. Well, why do I keep saying that the down moves are the impulse price swings? Because like I said, if our narrative, whatever your narrative is, okay, if you're expecting price to push higher, whatever, I guess you could say move is bullish, or whatever major swing to swing point is bullish, that would be your impulse price swing because you want price to go higher. But anything other than that, if it's like retracing, okay, we say retracing. Why do we say retracing? I say retracing because that's something the market has to do before the true direction comes out. So market protraction, in other words, is retracing before the impulse price swing really occurs. So here, if you want to go over it again, market retraces, impulse. Market retraces, impulse. Okay? And in those impulse price swings, what does it form? Displacement. Displacement occurs in those impulse price swings. Why? Because fair value gap. Right there. There's fair value gaps all in this little price swing here. I hate that my drawings can come back up, but it's all good though. You can still learn from this. But let's go on another pair. Let's go on, I don't know, NAS, okay? So, for example, here, let's say your narrative is bearish again. Price goes higher. Impulse. Price move higher. Major impulse. Bang. See that? Price moves higher. And then it consolidates for a little bit. And then impulse. Down. Yep. And then from this point on, your narrative is now bullish. If we really look into this and really see what's going on, you would see that the narrative is bullish here. But let's just jump on an hour just to make this easier for your eyes. Alright? So, market protracts or retraces. Yep. Bang. Pretty cool, right? Very cool. And then it retraces again. If we jump on the 5 minute, it retraces here. Market protracts, and then bang. It's very simple. Very, very simple. But you have to understand that's what price does. With the impulse, right? I taught you about displacement and manipulation, okay? We're going over the displacement side today. The displacement side is the impulse price swing, okay? Displacement, there's two terms for displacement, okay? The first term or the first meaning is, the expectation of where price wants to go, okay? If you predict that price is bullish, right? And price starts heading higher, you're like, okay, this is displacement. But if your narrative is bullish and price is heading down, that's either market protraction, okay, as in it's manipulating before it follows your narrative, or you're just on the wrong side of the market, okay? The second term of displacement is simply when price is moving extremely fast and creating fair value gaps or imbalances, okay? But in this case, we're going over the first term, okay, which is displacement. Impulse price swings are forms of what? Displacement. Okay, market protraction is manipulation before the true impulse price swing occurs. Okay, and if you want, you can call these price swings, the market protraction swings, you can call them impulse price swings too, because it's not like they can't be traded. Manipulation can be traded. I do it all the time. You can trade this down move. You can trade this retracement here. There's no problem with it. You can trade this and then run price right back up, sell it, and then buy it. There's no problem with that. I'm not saying don't do that. If you know how to do that and you get good enough and learn these concepts where I teach you well enough to where you can do that, do it. Do it. It's nothing wrong with that. It's perfectly fine. I do it all the time. Okay? Very, very simple. Let's go on, I don't know, Euro. Why not? Euro. So, let's look again. Let's look again here. We have an impulse price swing right here. Impulse, retrace, impulse, protract, impulse, we protract again, impulse, and do we have another small protraction right here, protract, impulse, okay, protract, impulse, again, very, very simple. And then price, from this point on, price literally just consolidated and just said impulse again, and didn't even give, the market a chance to retrace. But there was something I was just about to go over. And also, I forgot to go over something in the previous episode. Fair value gaps are institutional reference points, okay? And like I just said, impulse price swings, okay, are forms of displacement. And displacement results in what? Fair value gaps and or imbalances, okay? The only imbalance you know right now, if you're a beginner, if you are a true beginner, you're not some smurf or some troll learning from you right now, the only imbalance you know is the fair value gap, okay? So I'm going to be referring to strictly fair value gaps until you learn about the other imbalances and you really know how to use them. But impulse price swings create displacement, and displacement results in fair value gaps being created within the displacement. Okay? This is an impulse. Bang. Do you see that? Fair value gap. See that? Fair value gap. Okay, going over fair value gaps again. Fair value gaps are institutional reference points. What I mean by that is, yes, price is going to retrace back into fair value gaps, and it has to come back and refill them. But what price will do is it will, remember, listen to the word I'm saying. It'll retrace and or retract into a fair value gap to then continue higher or lower based off what the fair value gap is. And if you look right here, right, I think it's going to pull up on my drawings, but it'll be fine. Yeah, it did. It'll be okay. See that fair value gap there? What did price do? It came and rebalanced some of it. It filled some of it, or offered fair value, and it dumped. I just said something new, didn't I? What's fair value? What is offering fair value? Okay. Fair value, okay, I went over an episode, in the previous episode. There's two sides of the market. There's buy side and there's sell side, okay? You see this bearish fair value gap here, or this SIBI? There was too much of what here? There was too much sell side, okay? So if there was too much sell side, price has to come back and offer fair value to the buy side, okay, before going lower, okay? So it has to come back into this fair value gap, then go lower. Okay, but there's things called breakaway gaps that you haven't learned yet. Okay, don't confuse yourself. But there's things called breakaway gaps to where price doesn't have to come into the fair value gap before going lower. You will learn about that. You will learn about that, but don't confuse yourself. Okay, don't confuse yourself. Please don't. I actually beg you, please. Just calm down. All right, let's go on DXY now. Sure, why not? All right, let's do this. Let's just start from, I don't know, back. I'll go on like the 4 hour or something like that. Some time frame like this. Yeah, sure, why not? All right, let's start from all the way up here. Our narrative is bearish. Clearly, okay, and I'm probably saying that, but you're like, this already happened. How are you gonna say the narrative is bearish when this happened a month ago or multiple months ago? Well, this is just for teaching purposes. This isn't for, I don't know, I guess you could say to impress people. This is just to show you or give you an example. Okay, we're assuming that you're on the right side of the market, which is bearish, clearly. So, if we're bearish, so on so, or your narrative is bearish, the impulse price swings or the true moves would be, bearish price swings or bearish impulse price swing. As you see here, impulse price swing, or we have some retracement into what? Uh-oh, do you see that? That fair value gap right there. Came into it, and then it finally displaced away, or had an impulse away from it, okay? We protract, whoop, bang. Pretty cool, huh? We protract, or we retrace, bang. We retrace, impulse. We retrace, impulse. We retrace again, impulse. We retrace again, impulse. We retrace again, impulse. Okay, now this is where the narrative changes here. We're now on a bullish narrative. Price heads higher, shifting the market into a bearish structure. Your market structure shift is right there. Don't confuse yourself. Just don't do it. I know I said market structure shift, but don't confuse yourself. You'll be okay. Anyways, going back into it, price moves higher, shifting the market. Okay. We do have a tiny little retracement there into this fair value gap. See that little wick down there? See that right there? We wick down, having some sort of retracement. Do we push higher again? Price protracts, and then bang. Price is protracting again right now, so we can expect a move higher. Okay. And whenever you see price, okay, I'll give you this before you go. Whenever you see price moving in one direction and it's really like willing to move in that direction, I'll say willing, okay? I'm not going to say like showing confluences or showing all that. I can't say that because you're a beginner. I can't say these terms because I don't want to confuse you. But if you see the market or the market is clearly bullish, okay, or clearly bearish, bullish for example, if it's clearly in a bullish scenario or a buy program, okay, since this market is ran by algorithms, if price is in a buy program, you do not want to call the top, okay, and be some insider. You don't want to do that, okay? You can call the bottom in a bullish market. You're probably like, wait, how do we do that? Very simple. Just understanding manipulation. Very simple. Because if price is bullish, anything other than that is going to be manipulation, right? So if price is heading higher, up here, right? I just taught you about this in this episode. If price is clearly heading higher, okay, it's respecting the institutional order flow is bullish. It's respecting down close candles. It's all those terms. You don't know about them yet, but I'll go over them soon. When it's clearly showing that it's bullish, do not call the top. Instead, call the bottom or the bottom of the day. Okay, not the true bottom, not literally the bottom all the way from down here. No, not literally, but call the bottom while price is going higher, or like call the protraction or call the manipulation. Okay, but anyways, I've been yapping for about 14 minutes and 28 seconds now, going on 14 to 30 seconds. But anyways, I've been yapping for about that long about market protraction and impulse price swings. I'm gonna name it impulse price swings, but I did go over a little bit of market protraction also. But anyways, enough of me talking. I'll be in this episode here, and I'll see you on the next one. Peace.